last week certain things played out according to our expectations rather nicely, and they have created the start of what could be a pretty interesting opportunity. When we get in the last 2 weeks, we've had some fairly extreme price action, following some pretty extreme macroeconomic eventualities, particularly relating to Japan for the aforementioned, is obvious and we all know about it. Now, the initial reaction in the yen, which goes some way to explaining why we should be following the price action rather than news, is that the yen rallied significantly on the back of the problems in Japan, only to invite the Bank of Japan, with the backing of the G7 countries, to intervene. In 1995, there was the Kobe earthquake, which led to the low printed in the dollar yen at the level that we will recognise as 81.12. Over the last couple of weeks, we've seen the Bank of Japan intervene from the dollar yen, for example, crashing down to the low 70s. The intervention took place very quickly, brought us back to the 81.12. And last week, so that was 2 weeks ago, and last week we held above the 81.12, and the volatility in comparison to the week before quite clearly was a lot lower. But we've come back, reverted to the mean area of between 81.12 and 84.50 that we've been trading in for a number of months. Now, on the screen here is the yen index. This yen index is pretty much the inverse of the dollar yen, because the yen index, much like the euro dollar and the dollar index, is heavily weighted to the dollar yen. Now, what we have been looking at, until now, is this coiling pattern in the yen index following a steady trend into this coiling phase. Now, this coiling pattern here, this is the yen rallying from the tsunami, the disaster, for reasons of both Japanese safe haven currency buying and the idea or the consideration that all the rebuilding work that will need to happen in the yen is going to have to take place, which is economically supportive, and you need yen to pay for it. However, at this point, Bank of Japan has seen a great opportunity to sell the yen. Bearing in mind this is the first point that they intervened right here. Back last year, this was intervention by the Bank of Japan on their own. The intervention following here is the Bank of Japan being backed by the G7 countries. This is what happened in '95, okay, after the Kobe earthquake, when the dollar yen, and remember this is the inverse, so the yen, what we're seeing in '95, the yen rallying, and it recovers, the dollar yen recovers, or the yen declines in a V-shaped, precipitous decline, and it carried on going until, for months on end, without looking back. Now, the reason I'm labouring this point before we kick off on the yen index is because it's affecting. This is the major story in FX now. The yen is in serious trouble. It was already in trouble, or potentially it was already looking at a point of reversal here, before we get the information that the last 2 weeks price action has provided us with. Okay? This head fake, if you like, this failure to continue to the upside is major. We think fundamentally and act technically, remember, so we understand what's going on here. The outcome is negative. So, as we've seen in the last week, the weakest currency clearly is the yen. The second weakest currency is the Swiss franc. And it's worth noting, though, this Swiss franc, technically speaking, is still trending up. But the last week or so, we've come in for some weakness. Okay, this is a momentum high. Momentum precedes price. We're expecting higher prices. We're not seeing a structure here or anything in the Swiss franc, but recently we're seeing some weakness. The next weakest is the British pound. Obviously, those of you will recognise, those of you that have been looking at the cable recognise this to be the same. Again, I'm not going to put any levels in on these indices. It's a bit of a waste of time because a lot of them actually look like the currency pairs themselves. But by way of setting ourselves up for kind of weakness, I want to look at this. The 159.81 is where the horizontal line is here, equivalent. The pound it's not trending anymore. We've had weakness from the 163 to turn down towards the 159.81, and this is flat to negative. Now, strictly speaking, in terms of trending, the dollar index is the weakest. Okay, the US dollar is the weakest. However, I want to share the following with you, and I am certainly going to put a couple of levels these levels on your charts, folks, on the dollar index, and they are the following. Let's get a bigger picture first of all. Here's dollar index. Here's a dollar index. We've got to know where we've come from. To put things into perspective, from 2001, this is the picture of the dollar index. Now, from 08 to the present, we've got the lows made here of 75.30. Okay? These three, we're not going to be exact, we just need to allocate a line, because these three levels are not the same. This low, however, this is a significant point, it's a significant turning point. These lows, these two lows, this is a weekly chart still, remember. The first low 75.92, the second low 75.96. Okay? So that is our second line. It's a very significant line in the sand. Two weekly lows are pretty much the same level. We rally, go into another bull run, followed by the decline to the end of last year, and hey presto, we revisit this exact level here. That low, 75.91. Okay, between these three levels we're within 10-15 pips. Now to the daily, and I'm spending time on this because you'll see why in a sec. Here's the daily then. This is a momentum low. We expect further declines. We get them into another momentum low. We expect further declines, 76.40. Momentum low, we expect further declines, we get them. This is a momentum low. This point here, i.e. the price action last week, the low made here is a failure to make a new low. So far. Now, yes, we could trade back down, and 75.91 is the level, the last significant level on the weekly. The failure to make a new low in the dollar index is the same level in November 2010, and you recall the two weekly lows, 75.91 back here. Okay? So when we get a failure to make a new low, fine, we could trade back through here, but at the moment we are going to use this to establish the potential structural point. So failure to make a new low renders this the structure. So that high is 76.70. Friday we trade through, only to pull back and close just below the previous momentum low. Now, this is an area, therefore, we have to watch very closely. We hold above, we trade back above the 76.70. The US dollar will be, the risk reward is most definitely to the upside. So we're here now sandwiched between two very key levels. The 75.91 to the downside, so a move back below 75.91 in the dollar index is going to give us a sign for further declines, and it'll tell us that the trend in the US dollar is still intact. A move back above 76.70 will give us an indication that the sellers on the short side of the dollar index is seriously running out of steam. So if we're looking at potential trade plans, we've got the yen that is turning into a very problematic scenario, and we've got this dollar index around these price points that are extremely significant, at levels where the declines after major trends have stopped. Okay? Not only stopped, but reversed. So that's very much going to be on our watch list over the next couple of weeks. Now, the Aussie and the CAD are obviously the strongest. The Aussie is continuing its strength. The Aussie is the strongest, followed by the CAD. We don't need to look at them. They're just continuing their progress higher. Okay, helped by their commodity currencies. They're obviously helped by a weak dollar, and the S&P and the commodities are continuing to strengthen, so they're being helped across the board. Okay, let me just save that intro on the recorder, and then we'll take a